This guy says he has made over $2,000 per day with just two simple moving averages, the 20 and 200. Now look, respect to him, he's probably a good trader, but making a video and showing two simple lagging indicators and telling people that they can make $500,000 doesn't seem right to me. So today I'm testing it out. I've been trading moving averages myself for over a decade, and we're gonna see, does this strategy actually make $2,100 per day like he claims? We will also look what I would do side by side his strategy, and maybe we could even make it a little bit better. So let's break down the strategy in a little bit more details. He says 20 moving average is the trend tool. If it's rising under the price, it's a uptrend. If candlesticks pulls back and touches the line, obviously you would go long. Vice versa, if it's falling above the price, it's your downtrend. When the price retraces back into it, obviously you would go short. He also mentions that if the 20 moving average is flat, there's no trading because there's no momentum. He also uses the 200 SMA line, which will act as a floor and ceiling. Price pulls back into it, we go long. Price retraces back into it, we go short. He also mentions that he doesn't trade when the market is overextended, so if the moving average is very far away from the candlesticks, you don't typically trade because you are waiting for a retracement from the market. And lastly, he mentions that he uses multiple time frames. He trades on the 2-minute, 5-minute, 15-minute, and the daily chart. So yeah, on the surface, that looks pretty simple, but he didn't mention stop losses. He didn't explain risk management, position sizing, risk to reward, and of course, he showed nice and clean setups which worked out. Not the messy chop most people will get stuck in. And look, I see why beginners love this. It's easy to understand. You plot two lines and it works in theory, but to me, it's overly simplified. Yes, he made it work. I'm not gonna go down the rabbit hole and try to figure out whether it's true or not. It doesn't matter. All I know as a trader, without context, moving averages are fucking useless because they lag. They don't predict the price. They don't predict the move. They just follow it. And using them alone to time your trades is a recipe for disaster. And I can say that confidently because I've been using them for over 10 years. They have a place how to trade them, but you have to have context with them. If you're just gonna trade the two fucking lines, you're gonna have a bad trading day. Okay, time for some testing phase. I'm currently on Euro US dollar 5-minute time frame. Let's see where his strategy actually shines and works out. In a clear trending market, the 20 moving average respects it multiple times. We can see it just over here. First touch of the 20 moving average shot towards the upside. Again, we had a near touch. I believe he would count it, went towards the upside. Then again, touch over here, went towards the upside. So 3 to 4 trades you could have taken from this setup alone. So clearly the moving averages do work. Obviously, he didn't mention how he manages risk, so we are not sure whether we are covering, the 20 moving averages or covering the swing low over here. It doesn't really matter. I guess we could say 20 moving averages covered. It would have worked out over here, over here, over here. So let's, go with that. Let's say he covers the 20 MA and that's it. Anyway, this is the perfect example of how moving averages actually work, where trend is following perfectly and everything is handy dandy. However, the 20 moving average typically breaks and chops all of the time. That's why it's my least important moving average when I trade it. So we discussed the perfect scenario. Let's move on and follow the trend. So we have an obvious push towards the upside. This is where he wouldn't trade, because if you did, let's say somewhere over here, your risk to reward becomes, not very good. So we wait for a pullback, maybe over here. What would you do here? So maybe he would enter this trade on this candlestick, or maybe on this candlestick over here on the breakout, because on his video he didn't really clarify whether he enters when it's a breakout or not. Sometimes he showed when there was a breakout, it went towards the upside. It was a little bit cherry picked, so obviously we never know when it's gonna break out or not. So let's say we enter this trade maybe here, I don't know, or let's say, let's be fair, here we are covering this little swing low over here. Could we actually be profitable? Look at this. No, it goes towards the downside. Why? Because the chop that he talks about, you need to avoid the chop of the moving average, is lagging. The indicator is lagging. So we would never know the chop starts until it has already started and, we lose the trade. And that's the problem with the moving averages. We never really know. And then there's situations like this where on the 5-minute time frame, the moving averages 20 and 200 are at the bottom. We are currently in a uptrend. We can see the same thing happening on the 15-minute time frame, recent cross of the moving averages. we should expect, bullish pressure, right? That's what we are seeing. So all we need now on the 5-minute time frame is maybe a pullback towards the 20 moving average. So we could have entered the trade over here, on that bearish little hammer, or maybe that little bullish engulfing candlestick, target our previous high, maybe somewhere over here. But there's a problem with this trade. If you simply following the 20 moving averages, you would have get stopped out. Look, the 200 moving average also was broken past this area zone. But why? Well, because there's further context. If you didn't understand supply and demand, you would get screwed by the market. Look at this. This was a nice area zone. Strong rally, base, drop. Clear institutional footprint in this area zone, right? Has left the imbalance. The imbalance was filled. Touched the start of the institutional push. Started dropping towards the downside. Just following the 20 and 200 moving averages would get you in trades like this, even when there's no chop. It seemed like it was a great trade. 15-minute time frame was showing the same thing. Nice little crossover. Crossover typically means it's a bullish signal to buy, yet you get fucked over by the market. And this happens consistently. The issue is not that the moving averages don't work. They do. The issue is when you think 2 lines is all you need. Without structure, without supply and demand, without full confluence and proper risk management, you'll eventually get caught. I get it. That guy promotes simplicity. Keeping simple is what I promote. But without context, trading 2 lagging indicators is never a good idea. So now let's look how we could improve this approach and actually make it profitable, or at least prevent losses happening prematurely. All right, now let's build this as a scalping strategy. So currently we are kind of in a chop a little bit over here, as we can see, is going towards the downside a little bit on the 5-minute. 15-minute, however, is trending towards the upside nicely. There is a nice little curve on the 20 and 200 moving averages, clearly respected, and on the hourly as well. As we can see, we have a nice area zone. Now, why would you not enter this trade on the 15-minute time frame? Let's say over here. Well, because if you have a look at the hourly time frame, where is the supply and demand currently sitting? We know that the overall market trend is currently bullish, so we want to wait for our buying opportunity. The obvious demand zone is over here. Look at this. This would be a great demand area because there was a nice drop, base, rally. Typically means there is a lot of unfilled orders in this area. Of course, we have the imbalance over here that needs to be filled, but trust me, it's very likely to touch the demand zone after, or at least once it touches it, we should be expecting a reaction. So that's why if we just follow the 15-minute chart or something like that, we wouldn't probably have a good trading opportunity. Now let's see, it pulled back a little bit. Look at this, pulled back over here, a few pips, bam, shot towards the downside. Now it reacted with the 200 moving average, which he says, it acts as a ceiling and a floor. In this case, the floor has been respected, and we should expect, maybe some buying pressure. This is good, but do you remember last trade, he actually sliced like hot knife through butter because there was no strong demand area level, right? In this case, we have a strong demand area level on the hourly time frame. That's why the 15-minute chart is ideal for you to enter the trading position just off the 200 moving average, covering the demand zone by a few pips, around 33%, say, of the size of the demand area. And then you can target, a nice, look at this, we're pretty much 1-to-3 risk to reward ratio, and this would have been a profitable trading opportunity. And all I did was just add a little bit of context to improve this trading strategy drastically. So yes, following the moving averages work. I use them all the time, but without context you would get lost because there's a ton of breakouts and things happening on various different time frames. So if you don't filter your trades properly, you will get stuck in a bad trading position. We can see another example where it works and where it shouldn't work. Look at this. For example, we are trading over here, touches our 20 moving average. We're expecting a push. Boom, it goes towards the downside and it continues dropping down, actually further down. even more because the trend has changed. Now, it doesn't mean that the simple moving average did not work. It did. However, we just reached an area of demand just over here. Look, previous area of demand, left a footprint, went towards the downside instantly. And then we had the little one, two areas in one, which means there is going to be a lot of selling pressure of this point. There has to be orders filled because this is a favorable price currently for the institutions for whatever the reason. So as you can see, if we targeted, the area top, we would get screwed. Maybe you could have, profited a little bit just over here. However, it's not all doom and gloom when trading, a simple strategy like the 20 and 200 moving averages. I can see, situations where it definitely works. Let's say we remove this. And let's say we have a look what happened over here. So nice little exhaustion to the 20 moving average, bullish engulfing candlestick went up. Pullback went up. Pullback went up, right? You could have profited 3 times already with this, trading system. That's pretty good. But why? Because there is a solid imbalance over here. Look at this candlestick. The orders were not filled in this area zone. That's why the market didn't react, right? The orders has to be filled. The price moved out from this zone very quickly, so he has to fill in all the orders. Once the order's been filled, it starts touching, the actual institutional footprint where the move actually happened previously. Look at this sharp move. We're expecting a sharp move from this area zone. And if we just play the tool, let's see what actually happened. It continued dropping down and actually broke past the 200 moving average again, because this happens all of the time. The moving averages break all the time. 20 moving average breaks all the time. Context matters. I'm not saying the system doesn't work. It does, but without context, it's gonna be a very hard to make it work. But we can look. If we have a look over here, there is a gap. For example, right? A gap means the price has not been filled because over the weekend, on Friday, the candlesticks have closed. Weekends, it doesn't work. Sunday night, it opened up, and as we can see, consolidation, boom, started filling this area kind of zone over here. Filled it, boom, drop down, because this is an area of a supply zone, right? So once it touched it, or once it was reached by nearby, in this case, look, the 200 moving average and the demand zone reacted, boom, again, boom, look, touch, boom. That's the way the markets move. It's all supply and demand. It's not just random lines on the chart, because you will get stuck like this, in this chop for something. Oh, it's gonna break out, I pull back over here, I'm gonna enter this trade. Look, double confluence, 200 moving average and 20 moving average. Is it gonna go down? No, fuck no. It's not gonna go down because the overall market context is totally different. And this is what I'm trying to teach you guys. It's not about just moving averages. Moving averages is just one piece of the puzzle. Trading is hard. A lot of people claim it's easy. The more you learn, the more you will get paralysis analysis. I promise you that. The things you have to go through as a trader to learn, because there's so many nuances, it's absolutely insane, and that's why 90% of traders fail. But it's not all sadness. You can become a profitable trader. I promise you that, as long as you trade with context. So you can use this system. I typically use 20 and 50 moving averages. I dropped the 200 moving average for now to see my results. I've been jumping about, 20 and 50, 200. I dropped 20 one time, used 50 and 200. The system works. You just have to correlate it with different things. I also like to use I forgot to mention actually pivot points. Look at this. Look at this. I use this indicator. There's a lot of pivot points in this area zone, daily and weekly area zone, including the obvious demand area just over here. Boom and boom. It's a triple confirmation in this case, and that's why confluence is so important. You have a strong demand area, daily pivot, weekly pivot. There's probably gonna be some sort of selling pressure in this area zone, and as we saw, it went towards the downside, and boom, it never broke past these pivot points. Yes, it looks like it on the 15-minute time frame, but if you go through the charts, the weekly is held, and there's just wicks outside. this, weekly line. There's no breakouts. And of course, you can go the institutional route where you have a look at the COT report, but this is for another trading lesson. For now, if you want to join my trading group, link down in the description below. We've been smashing the markets recently. And yeah, if you enjoyed this little analysis, moving average strategy video, I don't know what to even call it, kind of review, kind of adding my own thing or two about, this, set strategy, let me know. I'll do more of these. If you want to watch another of my videos, click over here and take care, Lions. Have a wonderful day, stay safe, and goodbye.